Either in Wall Street or the Lal Street, there are only two types of people comes to make their fortune in the stock market. One is the predator, another is its prey. One make millions and another makes nothing but just few thousands in this centuries old money making game. But why? In today's video, you will find all of your answers. If you are the predator, congratulations. But if you have become the prey, then this video going to help you a lot. The main reason behind this is our decades old education system and wrong belief about the money. And the most importantly, the dark market psychologies that mass investors are not aware of. Because most of the so-called market enthusiasts takes their buying or selling decision based on the current market events and that has already occurred. And the predators on the streets want this to happen so that they can secure their billions doing totally opposite. That is the reason they keep you busy with current stock market news, events and brokers' recommendations. While the prey focuses on the results, predators focuses on its cause. The stock market predators successfully has built an early warning system that helps them every time to predict the upcoming economic crisis and market recession. For that reason, the mass investors lose money at the bad times when they make billions. If you want to know what are those early warning systems are, then stay with me till the end or else you do some other works in your life. If you are till now with me, then congratulations. You are damn serious about your money and this market crash will make you financially free forever. To become the stock market predators, you have to focus on the cause, not on the results that mass investors follow. Because I am here to transform you to the predator. What are those early warning systems that helps the top elites to predict the upcoming market recession? Number one, yield curve spread. That is the difference between the 10 years treasury bond yield value and 2 years treasury bond yield value. When the charts start inverting, it increases the probability of recession and the stock market crash. As I have already discussed, whenever the yield curve inversion have been witnessed, that is called the yield curve inversion, and it has breached the zero line and ended up in the negative quadrant, the recession followed soon after. The longest ever duration from crossing the zero line to recession hitting the stock market recorded was 2.8 years. That is from June 1998 to February 2001, and the shortest ever duration is of 7 months recorded between August 2019 to March 2020. On an average, the duration stands at 1.33 years. On the other aspects, after being bottomed out in the negative quadrant, whenever it starts climbing upward and crosses the zero line in the positive direction, that is called the yield curve steepening, the recession has arrived just within 6 months on an average. Now the present yield curve reading showing that the yield curve inverted and started entering into the negative quadrant on 5th of July 2022, and as of now more than 1.5 years have been completed from that date. That is well above the average duration of 1.33 years, but recession still has not appeared so far. From that point of view, we might still have 6 months waiting period to see the next recession. On the other context, the current value of yield curve spread chart is minus 0.19. It is yet to breach the zero line. That is also suggesting that we might have 6 more months to see the next recession and market crash. So in both the cases, we might have 6 more months in our hand. But most of the US investors are too much optimistic about the US economy and the stock market, and similarly the stock market is now standing at high greed zone. 6 out of 7 fear and greed indicators suggesting that the US stock market is in highly greed zone. In such situation, would you like to become the predator by getting prepared for the next market crash, or the prey? Totally depends upon you. Number 2, interest rate. Most of the people believe that the interest rate decides the stock market's movement. Under lower interest rates, the financial market moves upward, and higher interest rates, the market starts declining. It just acts like the gravity, and most of the people takes the investment decision on the basis of that. But this chart represents complete different story. The blue line represents the S&P 500 and the red bar represents the US Fed interest rate change. It shows even if the US Fed rates have gone up in the several occasions, the S&P 500 has also gone up too. And whenever rate of interest started moving downwards, the S&P 500 also started moving downwards too, and gradually has entered into the recession. Only whenever the interest rate stays lower, I mean to say near to zero for a longer period of time, the S&P 500 started rallying a lot. According to me, this period is the best time to take long-term investment position. According to me, that phase can only be called the reverse market crash that has already gone. According to best of my knowledge, what most of the investors and analysts are predicting about the reverse market crash or giant market rally that is going to take place when the US Fed will start cutting rates, it's not correct. Rather, I believe, like other previous scenarios, if the US Fed really starts cutting policy rates, it will confirm an weakening economy and the attempt of US Federal Reserve to avoid the upcoming recession. Because the decision of either raising or cutting the interest rate by central banks are based on the economic conditions, not on the basis of their own personal choice. If the central banks decide to raise the interest rates, that suggests that the economy is running extremely well and there is a need to control its extraordinary growth to curb the inflation in near future. And the decision of raising interest rate will not hurt the economy badly anymore. On the contrary, the full stop on the interest rate hike or cutting the interest rates indicate that the central banks are predicting some unfavorable economic outcomes waiting ahead. What market predators make us to believe is not the truth. As a proof, if we can blend this yield curve speed chart and S&P 500 and Fed's interest rate chart together, then you will find that every time when the rate of interest starts declining and the yield curve starts steepening, the recession appears in the US economy that spread to other major economies including India, China and many other emerging economies. So remember, this point of time, rate cuts would be indicating another recession and the stock market crash, not the bull market rally. Try to think like a predator, not like a prey. Number 3, M2 money supply. The third most important alarming bell is the drop in M2 money supply. Basically, when we discuss about the money supply in the economy, we generally consider two types of money supply. Number 1 is M1 money supply and another is M2 money supply. M1 is a narrow measure of the money supply that includes currency, demand deposits and other liquid deposits including saving deposits. Whereas M2 money supply includes everything in M1 and the US Federal Reserve's estimates of the total money supply including all the cash people have on their hands plus all the money deposited in checking accounts, saving accounts and other short-term saving vehicles such as certificates of deposits, retirement account balances and time deposits. This chart is showing how the M2 money supply has drastically gone down in USA in recent years and it is at the lowest ever level since 1960s. Confirming this trend, economists are also predicting the collapse of US economy due to the spike in unemployment and deflation. Number 4, the market cap to GDP ratio. The next warning signal is the market cap to GDP ratio. It is the most important warning signal that considered as the Buffett indicators by most of the investors in the investment community. It measures the market cap of the stock market compared to the GDP of that country. If it is greater than 100%, then it is considered that the stock market is highly overvalued. In 2000, this value was 147.48% and then the recession had hit the market within a year. Then in 2007, before the financial crisis of 2008, it reached at 107.81% and again the stock market crashed just after that. And then the same thing happened in 2020 when the reading of the indicator reached at 157.89% just before the COVID crash. And now after reaching at 203.17% mark, it is standing at 177.78%, that is highly overvalued. In such point of view, we can see another major market crash very soon. At the end, the last indicator that I will be discussing is the unemployment rates, and the more specifically I will be discussing about the indicator that can predict the actual stock market crash at a perfect time. And this indicator is the sum rule indicator. History proves whenever the unemployment rate in US has gone below 5%, the US economy has suffered a major recession. And now the unemployment rate as per December 2023 is 3.7%. That is well below the historical range of 5%. That is probably indicating the stock market crash is imminent. And for more confirmation in this regard, we have to look at the sum rule. Sum recession indicator signals the start of a recession when the 3 months moving average of the national unemployment rate rises by 0.50 percentage point or more relative to the minimum of the 3-month averages from the previous 12 months. This red line is suggesting that 0.5 percentage mark is yet to be breached. So from that aspect, recession is not nearing soon immediately. But as most of the American companies have started laying off their staffs due to economic slowdown, and if such situation prevails for a couple of more months, then no one can prevent the upcoming recession in US. And according to the sum rule, if the present reading of the sum recession indicator reaches at 0.50% mark from the current reading of 0.23 and the unemployment rate crosses 4.2% from that present unemployment rate of 3.7%, we may witness a big bubble burst, and that would be the starting of the new recession in US and across the globe. So at that point of time, it is advisable to stay in cash and wait for the biggest opportunity that is likely to come in form of recession and stock market crash. So that's it for today. If you like this video and want more informative videos like this, then kindly subscribe my channel. Till then, bye bye.